What's going on, guys? Welcome back to the channel. In this video here, we're doing an analysis on Pepsi. Now, my last video, I did an analysis on Coca-Cola, so I said, you know what, it should be fair, do an analysis on this company that I never ever had a Pepsi before. So, fun fact about that. So let's jump into the stock research tool here, built by yours truly. So, loading up Pepsi, we're grading this company a 5 out of 10, and in my last video, if you took a look at it, you probably find it up here if you want to watch it. Coca-Cola also ranked 5 out of 10, so fairly even company. So we're going to see what's going on. Where are they losing points? Where are they gaining points? They're doing well in the return on equity average. And so 56% compared to Coca-Cola. I think they were sitting at like 30. But we want to see this number over 15%, folks, and they have that, no problem. Massive EPS growth, as well as they have net income growth, as well as return on invested capital growth, and revenue growth. Interesting. Coca-Cola didn't have revenue growth. They had free cash flow growth. And Pepsi is losing free cash flow. I don't know how I feel about that. Pepsi has a low current ratio sitting at 0.87. We want to see this number a 1.5 or higher. Now, I remember Coca-Cola was sitting at 1 point something. So no points there. The PE ratio is sitting at 26.59. We want to see this number underneath 22.5. It's not the worst PE ratio, and the trailing 12 months, if we look at the company metrics category, is sitting at 23. So it's around there. But you know what? A point is a point. We got to deduct and give wherever it makes sense, taking the emotions out of it. So no points awarded there. We're getting slightly diluted with the shares, and as they increase the shares by 0.14%. Big whoop. We want to see this staying the same at the worst, and the best being them buying back shares. But 0.14% increase over the last 5 years, it's not the worst. However, the scary part about this company, and this problem I have with Coca-Cola, is the debt to equity ratio. These guys are, I thought Coca-Cola was horrible. Pepsi sitting at 224%. My God, guys, what are you doing? That means their creditors got such a strong hold on them to pay off their debt. They're instead of growing the business through equity. We don't want to see this, folks. That means in the case of a recession, listen, like, the more debt you take on, and if anything happens where you're unable to pay back that debt, what do you think is going to happen? The worst possible outcomes. Hey, you can't pay us back? Well, guess what? We'll just start taking stuff until you can pay us back. As well as they're suffering another similar problem. $5.8 billion in free cash flow is being allocated to dividends. And if you watch my last video, it's going to sound very much the same. Our free cash flow also is at $6.4 billion. A majority of this free cash flow is being burnt towards dividends. Why? Why on God's holy earth are you allocating so much money towards, this goes towards both Coca-Cola and Pepsi. Why? To upkeep this dividend. It's one, it's not tax efficient, and two, like, really? This is the hill you're deciding to die on? Anyways, I digress. I don't like when companies have this much free cash flow dedicated towards just a dividend, and people are buying into this company for the dividend. And guess what, folks? If they can't pay off the dividend, you're not getting the dividend, and then and then it's like, what is this? A cycle of we have to keep taking on debt so that we can use that debt money to pay off our dividends. Oh God. However, what can I say that's positive? They got net income growing, I guess, and revenues growing. That's a major plus. Coca-Cola did not have this, so I mentioned that earlier. So they have a decent Almond Z score, sitting at 4.11. We want to see this over 3. Piotrowski score is meh. So 5 out of 10, somewhat justified. It's just this middle of the road company that if you're buying Pepsi or Coca-Cola for that matter, most times you're just gonna buy for the dividend because they're a dividend aristocrat. You should never buy a company based off that metric alone, and unfortunately so many new investors do that. And listen, I'm guilty for that too. When I was starting off, I said in my last video, Coca-Cola was the first American company that I bought. I'm Canadian, so for me it was like, oh wow, getting into the US market. But I bought it based off of a recognizable brand, as well as a dividend, because I'm like, oh, I like getting paid every other quarter, as well as Warren Buffett. No fundamental analysis other than those three aspects right there, and I went in and I bought a bunch of shares of Coca-Cola. That dividend reason should be thrown out the window. Cool, Warren Buffett bought it back in the 1970s. Okay, different time, different place. But on this channel here, folks, we're trying to do a fundamental analysis on all these companies and look at it as if the stock market wasn't here. We're looking at what's actually being shown to us from a numbers perspective. So with Pepsi, if you were deciding to buy this for the dividend alone, run away. There are other companies you could potentially go to, but you shouldn't do that anyways. We're trying to do fundamental analysis. We're going to jump into a price analysis of this company. We're going to determine a fair price to pay for this business. We'll do a 10-year analysis. I'm going to fill out these boxes here, folks. And if you're enjoying the video so far, hit that like button, hit the subscribe button. I'm going to fill out these boxes, and then I'll touch base with you in just a quick second. I'll explain to you the method behind the madness. Take a look at this. If you're brand new to the channel, guess what? I like to stay conservative. I'm doing 2%, 3%, and 4%. Profit margin, I kept it the same because I believe they could probably hit those numbers with a slight haircut. Same thing with the price of free cash flow. I discounted the price of free cash flow. I said 14, 16, and 18. Same thing with the PE ratio. But our free cash flow margin, I kept it at numbers I believe they can hit. Desired return, I put 13%, lucky number 13, as you know. And folks, if you're trying to get your hands on the software that I've been showcasing here, stay tuned. It's going to be out, available to you. I'm only showing you one section of the software here, folks. We got the cash flow statements, income statements, and balance sheets. We got all sorts of data. So just to do a quick little sidestep here, get the income statements and stuff like that, and charts to see everything from a visual perspective. We got a lot of options here, folks. We got a lot of things on the software. It's not just this lovely page that you got in front of you. But jumping into this price analysis, take a look at this, folks. $80. $80 is what we're paying, or we should pay for this business, half of what it's currently at. And that kind of makes sense. We cut the PE ratio pretty much in half of what we currently have, as well as our same thing with our price to free cash flow numbers as well. So that being said, folks, is 169.39 is the current price. $80 is our average price. On the high end, we have 101 with a 4% revenue growth. I think it's somewhere in this realm here, 60 to 79. You know what? It gets down to $70. There may be a time to pick it up. Because I think at the current metrics of what we currently have, you're overpaying for this. Debt to equity, super high. Current ratio, not a fan. As well as we are losing some free cash flow growth. Let's take a look at what's happening over there. What's the full story? Let's go annual basis and see what's happening. Yeah, 7.36 billion, 7 billion, and it's slowly been going down. I'm not too happy about that. So this is what I mean, folks. You gotta look at the full story. What's going on with this company? I get it, it's a consumer staple. I don't think it's going to be going away over the next 10 years. But if the financial sheets are rocky, you know, it just takes one bad swing, and the next thing you know, this company could be suffering a lot. We don't want to buy businesses like that. At least I don't. So do with that information what you will. But this software is going to be coming out soon, so you can plug in your own numbers, research your own companies, and there's so many other options and tools that we're going to be integrating in the future. So stay tuned for that. So my final thoughts on Pepsi. I'm not holding my breath for this. There's other businesses out there that are worth my attention. If it gets down to this 70 mark, below 80, I'll put it on a watch list. Maybe put a little alert. But I can't justify this price here, and neither should you personally. But that's just my opinions, folks. Stay tuned for another video Monday, Wednesdays, and Fridays, folks. That's where we drop stock analysis videos. Thank you so much for watching. Until next time.